and welcome to Market Domination. I'm Julie Hyman, Shauna Smith, and for Josh Lipton today. Live from our New York City headquarters, we are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz getting you up to speed 1 hour before the closing bell rings on Wall Street.
This is really an opening volley by Trump to say he's really serious about tariffs. Tariffs will happen. The amount of the tariff and what the negotiation standpoint is still unknown. So this is like, hey, I'm throwing it out there. You're going to come to me. We're going to have a negotiation. We're going to try to figure out how you are going to invest more in America. And that's really what I see as the statement that Trump is making here. This is why we're looking at April and not tomorrow.
This is a stock that in 2.5 weeks went from 670 to 740. Just seemed like a runaway train almost to the upside. And it's fantastic. And I just think what's happened over the last week, I actually don't know that this is necessarily a longer term trade for many people. But I think what happened is people were looking at this and saying, okay, this is kind of insane of how fast this stock has gone up without really taking a breather. And so I think many people were just playing it for what has happened over the last couple of days and seeing, things come back to earth a little bit.
Results pretty good. They beat handily, 80 cents on the quarter, well above the 67 cent consensus view, and actually better than last year's at 74 cents. I think Oxy is doing a pretty good job at sticking to its knitting and delivering as best it can.
We got 1 hour to go until the market close, so let's take a look at the major averages, Shauna. And we don't have much change today, but this kind of continues the trend we're seeing. You just heard a couple of examples of the individual stocks that are moving more. So this continues this trend where relatively placid on the surface, but a lot of big moves underneath. So that placidness, right? The Dow barely higher, was lower for much of the session, moved a little bit higher after Fed minutes, although there wasn't really any big change of perception in the Fed minutes. Now not even up a point. The S&P up 0.25% and looks like it's going to close at a new record. It touched an intraday record as well today, and the Nasdaq up about 0.25%.
Yeah, we haven't seen too many more broad-based moves, I guess, when you take a look at the major averages, but you're right, underneath the surface, very much an earnings-driven market. We've talked about the importance of earnings into maintaining some of that momentum. The fact that we did see another intraday record high here for the S&P, of course, that points to that ongoing momentum that we have seen in the market and the ability here really for so many investors to shake off any of those concerns out there. We heard from the Fed minutes. Obviously, policymakers are still concerned about inflation. And then, of course, you have the tariff story going on. Despite all that, though, we still have this move to the upside here. Again, another record intraday high for the S&P. And that's very much, I think, has been remarkable and also reflective, really, of that ongoing improvement here in sentiment.
Improvement in sentiment and broadening, right? Like the broadening that everybody has been calling for finally appears to be happening. Today, for example, healthcare is the best performing group. Not anything to do with tech. Energy next to healthcare. Consumer staples doing well. And we've been looking sort of at the year-to-date numbers, too. And again, there you're not getting, yes, communication services helped by Meta is the top group, but then you got financials and energy that have also been performing. And if you look at the Nasdaq year-to-date, as we've also been talking pretty regularly about, if we're going to go to the Nasdaq 100, there it is. Here are some of the year-to-date returns there. Again, Meta up 20%. But the other Mag 7, it's sort of a mixed result here, which shows, again, the broadening that's been pushing things.
Yeah, very much so. And I also think when you take a look at the year-to-date returns of the S&P versus the equal weight S&P, they're not too far off. And that's very reflective of some of that broadening, the broadening trade that we have very much been waiting for now for quite some time.
Yeah, exactly.
All right, well, stocks are higher as investors weigh President Trump's latest tariff threats and minutes from the Fed's January meeting. For more, let's welcome in Adam Johnson. He's Bullseye American Ingenuity Fund portfolio manager. Adam, it's great to have you back here on Yahoo Finance. So what do you think of this momentum that we have seen in the market? We just talked about the fact that we did see another record intraday high here for the S&P, and this is coming, of course, today, despite some of those inflationary concerns that we're getting out from Fed officials.
There is far more to like than to fear. So I've been fully invested now for quite a long time. And anyone who's seen me before knows that I tend to be an optimist. I tend to be fully invested. But especially right now, I think it's a golden moment to invest in America. And I tell you why. For the first time in many, many years, we have Wall Street, Main Street, and now Washington all aligned towards growth, efficiency, fewer regulations, lower taxes. It's a wonderful, wonderful story, and it's playing out in the numbers. We've got GDP rising somewhere between 2.5%, 3%. We've got unemployment way down still at about 4%. And now we have earnings growth of 11 to 12%. There's a lot to like. So yeah, I'm very comfortable being fully invested, and all the uncertainty that we can talk about, from tariffs to rate cuts, et cetera. Honestly, none of that matters as much as the bigger picture.
You know, and it feels like the market has definitely shrugged off some of the tariff back and forth until there is sort of more concrete, bigger action. That seems to be what the market is waiting for, certainty on that front to react to here. So, you know, Adam, I know your playbook is just sort of looking at the fundamentals of companies.
Yeah.
Are you, how much are you even paying attention to macro in this environment?
I'm not. And I'll tell you why, Julie. Just look at what's happened over the past 3 months. We've had 3 one-day sell-offs of 3% or more, and within 3 days, that 3% loss was completely made up and stocks went on to make new highs. So the message of the market is that there is a ton of cash on the side that will actively and aggressively, I hate to say buy dips because that sounds so cliche, but effectively, yes, there's money that is going to come in and buy stocks. So I look at all these little sell-offs that happen from time to time. Seems like about, you know, every 5 to 6 weeks we get some sort of downdraft. That's an opportunity to just figure out which of your favorite names are down the most. And if you're fortunate enough to have cash and you can deploy it at that moment, that's what you buy. So I'm not worried about the big picture. And yes, as you point out, that gives me a chance to do what I love, which is to find great growth companies that have a long runway ahead of them, where I can buy them and try to double, triple, or quadruple my clients' money over the next couple of years, because I've looked at the cash flow and I've done my models and I've said, yeah, this is a reasonable multiple to put on this kind of growth, and here's where I think the stock will be in 3 years. That's my approach.
Adam, what are some of those names?
Say again?
What are some of those names?
Oh, well, one that we're all talking about certainly today, Super Microcomputer, SMCI. As I look over on the screen right now, it's up about 16%. It's been up 15 or 16% several times over the past several days. And I'll tell you what's going on there. This is a company that effectively creates platforms for artificial intelligence. They go out and they buy NVIDIA chips. They go out and they buy Marvell chips and storage systems. They then go out and purchase racks and Broadcom servers, link it all up together with wire, run liquid cooling through it. Now you literally have a platform on which you can perform artificial intelligence. There was a short seller, you may remember Hindenburg Research, since out of business, that alleged the company had some accounting irregularities. That was back in October. The stock plummeted. And as it turns out, 2 weeks ago, they announced, management announced that an independent review had found no evidence of any impropriety. And as a result, the stock is rallying back. It's still, in spite of the fact that it's up, look at that, what, 15% today, 15% yesterday, it's still only trading at 10, 11 times earnings. An artificial intelligence company ought to trade at 25 to 30, maybe even 35 times earnings. So just on the reflation of the valuation, this stock can rise significantly. Add to that the fact that management said they're going to grow this year at 60%, and next year 65%. You just put a 25 or 30 multiple on those forward earnings. My target's 190. Again, the stock is 63 right now. We're showing it right now. So those are the kinds of companies. That's an exceptional one, that kind of growth and that kind of story, but that gets towards the type of name that I like to find for my clients.
I want to ask you a question about SMCI specifically, because as you mentioned, Hindenburg had that short report out, and a lot of people followed and shorted the stock. We had just gotten the freshest data from S3, which tracks short interest, and there is a heck of a lot of short interest still in this stock. A lot of people have been covering their shorts, obviously. Well, that was going to be my question to you. As a fundamental guy, does it bother you that this is such a speculative name, both to the up and the downside, when you're looking at the fundamental growth story?
No, because I've looked at the fundamentals, I'm comfortable with them, and now all the shorts have to cover. That's called a short squeeze. I think it's one of the reasons why the stock is up so much. And just
You
the
think?
fact that,
Yes.
yeah, they're getting squeezed, and it couldn't happen to a nicer group of people.
Adam, what about NVIDIA? I know that was another name that you sent over, just given the valuation side of it, given the fact that it's only trading at about 30 times earnings. What does that upside then look like? And is it attractive at these levels?
Oh, yeah, it's extremely attractive. So NVIDIA, again, another stock that's growing somewhere around 60%. We don't really know because they continually beat the estimates and they end up growing faster. I mean, there was a time when NVIDIA was doubling and tripling earnings. Those days are over. That's why the stock tripled last year. But at this point now, it's sort of settling in. It seems funny to say that, but settling in to growth somewhere between 50 and 75%. So you think about it. You can buy the S&P 500 at about 21 times earnings, and you'll get 10, 11, 12% growth. Or you can pay a little bit more. You can pay 30 times earnings for NVIDIA, and you get that 50 to 75% growth. So I would much rather pay up for an NVIDIA and get that kind of growth. Google, another name that I've been telling people to buy, only trades at 19 times earnings. I mean, that's cheap when you consider the fact that Apple, Microsoft, Amazon, Meta, they all trade somewhere between 30 and 35 times earnings. And then you've got Google trading at 19. I mean, to me, that is something you got to own. Meta and Google are the only two places in the world where 2.2 billion people come together every single day. I want those eyeballs because the ad numbers and the growth are staggering. So yeah, Google's another one that absolutely people ought to be buying.
And as for NVIDIA, we get the numbers from that company a week from today. Adam, it's great to see you. Thanks a lot for joining us.
Oh, thanks for having me. Love talking stocks with you.
Talk to you soon. We're just getting started here on Market Domination. Coming up, Atlanta Fed President Raphael Bostic will join the program to discuss the state of the economy as well as the central bank's fight against inflation. You don't want to miss it. Plus, at 3:30, it's the latest edition of our series Goodbye or Goodbye. We're taking a deeper dive into two stocks to help you make the best moves for your portfolio. Stay tuned, much more Market Domination coming up. It is unclear when the Federal Reserve will cut interest rates again as policymakers weigh how far Trump's tariffs could spur inflation. Fed officials have reiterated they expect to keep rates on hold while they assess the state of the economy. For more on all of this, let's send it on over to our own Jennifer Schonberger, who's joined by Atlanta Fed President Raphael Bostic. Jen?
Thank you, Julie. President Bostic, thank you so much for joining me. It's great to see you. I think the last time we were together, we were sweating in Jackson Hole, and now at least it's freezing here in Washington.
Well, it's freezing in Atlanta by Atlanta standards as well, so we're sharing the same day.
All right, well, hopefully things will heat up soon. And speaking of heating up, inflation seemed to heat up in the month of January with the latest reading on the Consumer Price Index. Producer prices came in a bit better, offering some hope for your favored inflation gauge, PCE. But given that inflation spiked in the first quarter of last year, and now we're seeing the uptick again in January, given that there was hope we would see easier comps that would provide some progress on the inflation front, to not see that now, are you worried that inflation is indeed heating up, or is this some sort of seasonality we're seeing at the start of every year?
Well, let me start by saying I get paid to worry, so I worry all the time about everything. I will say that with inflation, one of my expectations for a long time has been that we would see progress from the very high levels that we had in the middle of the pandemic, and that's exactly what we've had. And then once we got to September and we were getting closer to our 2% target, I didn't expect that the progress would go in a straight line. So bumpiness and a data point here or there that might send a different signal is not something that's super surprising to me. I think the biggest question right now is whether that data point represents a new trend or just a bump in the road. And that's what me and my team will be looking at over the next several months to make sure that we draw the right conclusion from those January numbers.
Yeah, and that January reading came before any tariffs or any changes in policy. And the minutes released from your last policy meeting this afternoon with a 3-week lag showed that you and your colleagues are worried about potential changes in policy, whether it's tariffs or immigration, and that could pose a risk to higher inflation. How are you factoring that into your outlook for inflation?
Well, look, I think that's a very good question, and I'll just say it's very difficult to factor all of these potential changes in. And I want to emphasize the word potential. For many of these policy areas, we don't have a final policy in place. So right now, we're just kind of trying to keep our eyes on the ball and make sure we understand what's going on. Until that's the case, though, I had an outlook that 2025 would proceed at a very positive level. We'd see solid growth. We'd see inflation continue to move to 2%. We'd see labor markets stay solid. Now, all this potential change, though, means that the confidence band, the precision of that estimate, in my mind, has reduced somewhat. And we'll just have to see how things play out over the next 3 and 6 months. And as we get more clarity on exactly what the policies are, then I'll have a better sense of what's going to happen in the economy. One thing I should also emphasize here is that in addition to some of the policy change that people are expecting might be inflationary, there are others that could go the other way. For example, we've heard a lot from my contacts about the prospects of deregulation, spurring a lot of investment that could increase productivity in ways that could show progress in terms of growth without putting that pressure on. So the details are actually going to matter here, and that's really what I'm going to wait to see.
I know you just said the details are going to matter here, and we need to look at the holistic picture. But to be sure, as the minute said, you are looking at these policies and think they could potentially push inflation higher, correct? Yes or no?
They could, and they could go the other way as well. It's really the whole mix because, again, I've talked to a lot of business leaders who are quite optimistic about what's going to happen on the regulatory side in particular. And they think those effects may actually swamp what happens in other areas. And so I don't want to presuppose anything at this point. As I said to start, I'm worried about everything, but I definitely want to make sure that before jumping to any conclusions, I see precisely what the policies are.
In talking with businesses on the ground, given that consumers are fed up with inflation, probably not going to be tolerant of more price increases, When we do see tariffs, do you think they will get passed on to consumers, or businesses are going to be forced to eat the majority of that? And what does that mean for the overall inflation picture? Does that get bottled up sort of in the supply chain, on the business end at the expense of profits? How do you see that playing out?
Well, this is a question we've been asking everyone because the notion that there would be tariffs have been out there for a while, and we wanted to get a sense of what people are thinking. So in our surveys and in our conversations with leaders, we've asked them what are they likely to do, and what they've all said is that our first best choice would be to pass on this to the final price. But I would just say, and you noted this as well, we've already had a period of intense inflation. Consumers may not have an appetite to do that. So we will have to see sort of how that interplay occurs, and that'll really determine what the final outcome is. I do have a sense. So I talk to a lot of business leaders as well, and what they tell me is that their customers are pretty much tapped out. So there is some uncertainty about what the final landing point is going to be. I think it's actually quite different than what we saw in 2017 when we hadn't had that inflation and consumers had a little extra space to be able to take on some price.
So, are you worried that you should be more restrictive now? Do you think you cut too much last year?
So I don't think we've cut too much. Look, I think we are still in a restrictive posture. That's what we need. And as inflation gets closer to our 2% target, the ideal way for our policy to move forward would be for us to get to our neutral level right at that point. That would mean we couldn't wait until we got all the way to 2% to start reducing our rate. So what we've done is appropriate. Now, of course, now we have to see sort of what that means for how the economy is going to evolve. And that's what we're doing now. It's one of the reasons why I've been really comfortable with the idea that we would take a pause and wait and see how the economy is evolving, and then use that information to guide what our policy should look like over the next several months.
Just to your point, you've said that you want more clarity on policy changes before deciding which direction to go with policy and how fast. But given that this administration is constantly going to be rolling out policies over the course of this year, what is the prospect that you remain on hold for this year entirely and that there aren't any more rate cuts this year?
So I don't have insights as to all the things that the administration may roll out. And if it is a year, then I think what would happen is that it would be take a longer time and it'd be slower for us to get all the way back to our neutral level. But I don't know what the future will hold, and I'm just going to be ready to take it on board as things happen. I do expect that we'll get
So cuts are still on the table?
Say that again?
So cuts are still on the table?
Sure. Everything is on the table at every meeting. I do think that I go into every meeting open to the possibility that we might take any kind of action based on what the data at the time are. So I'm not taking anything off the table. I'm not putting anything extra on the table. I would just say that we're going to let the data guide how my team looks at it, and then I'll go into the meeting with a view based on that as to what the appropriate action will be.
The minutes also noted that some officials are in favor of slowing the balance sheet or perhaps even pressing the pause button if we were to see any hiccups surrounding the debt ceiling. Are you in that camp? What are your thoughts on that? How did that discussion sort of play out within the meeting?
Well, look, first, I want to say I'm very supportive of the idea of getting the balance sheet down in size away from its emergency level. And we've made good progress on that. The reality is that as we do reduce the size of the balance sheet, we get to that threshold level. There's some threshold level where we're not going to want to reduce it any further because it'll affect volatility in money markets and other things. I think we're getting to that level, close to that level, and there's not precision on that. And given that, I think it's going to be appropriate for us to be more cautious today and moving forward than we have been in the past 6 or 8 months. The debt ceiling is one factor that comes into that, but there are others as well, including how banks decide to deploy capital across their investment instruments. So this is something I want to look at more broadly and make sure that we are paying attention day to day and make sure that we don't go too far and create volatility in the marketplace that could potentially be avoided.
And President Bossack, we'll have to leave the conversation there, but thank you so much, as always, for your insights. So appreciate it. Hope to talk to you again soon.
I look forward to talking to you, and hopefully it'll be back in the sunshine.
Yes, amen. Thank you so much. That was Raphael Bostic, president of the Atlanta Federal Reserve. Julie, back to you.
Well, and as Fed officials worry about the impact of tariffs on inflation, Fed minutes did show that officials would need to see inflation come down more before lowering interest rates further. We just heard from Atlanta Fed President Raphael Bostic talking to us about the challenge of factoring in what's going on from a policy perspective. Yahoo Finance's Jennifer Schomburger still with us here to discuss kind of what we heard from the minutes, what we just heard from President Bostic there. It was really interesting, I thought, what he had to say about his conversation with people in business and the sort of balancing effect that we could see on the economy from the threat of tariffs on the one hand, and on the other hand, the optimism that business leaders are expressing to him about deregulation.
Yeah, absolutely, Julie. I mean, the minutes clearly showed that the Fed officials are concerned that tariffs and any changes in policy could create upside risk for inflation. And Bostic acknowledged that in the interview. But when I asked him about how businesses are planning to deal with this, he said, look, we need to look at this with a holistic picture. And that's how businesses are looking at this. Yes, tariffs could add on the inflation front, but businesses are also really excited for the prospect of deregulation. And so he says that could create some offsetting factors there. So he's really going to need to look at this net. The other thing that stood out to me is, yes, they are taking a pause right now, but cuts are still on the table. They're not thinking that, hey, cuts are off the table for the remainder of this year, even as this administration is looking to go full force, and we're going to see new policies repeatedly rolled out over the course of this year.
And Jennifer, to that point, Bostic really just emphasizing how difficult it is right now, given so much uncertainty coming from D.C., whether that is tariffs, whether that is immigration, some of the things that were also noted within the FOMC minutes. And what was interesting to me, and going off of what you were just saying, just about everything being on the table, just how much more clarity policymakers are wanting and need really before they feel comfortable making that next decision.
Yeah, absolutely. I think uncertainty is the name of the game right now, and that's why officials are hitting the pause button. And you saw that also in the minutes today, very much taking a cautious approach. And Bostic acknowledged himself during the interview that he wants to take a pause here, to take a step back, see how things play out. One thing I didn't get to ask him is, depending on how long people are sort of waiting around businesses, does that put a damper on growth? We don't know. We saw a little bit of that the last time during Trump's first administration when he put more targeted tariffs on China, for example. So we're really just going to have to wait and see how all of this plays out and how other countries respond, right? Is it going to be one where, you know, the president yesterday discussed the notion that Europe is now matching our tariffs on car imports, so now it's going to be 2.8%. That's a great outcome. Or are we going to see escalation that is going to be more inflationary? We really just don't know.
All right, Jennifer Schomburger, great interview. Thanks so much for bringing that to us.
Thank you so much for having me.
Continue this conversation. Joining us now with more reaction to Raphael Bostic and the January Fed minutes, we want to bring in Eric Rosengren. He's the former president of the Federal Reserve Bank of Boston, also visiting scholar at the MIT Golub Center. It's great to have you here, Eric. Thanks so much for making the time to join us. So let's combine some of the commentary that we just got from Bostic as well as what we're hearing or what we're seeing from the Fed minutes. Obviously, inflation very much still a concern here amongst policymakers. They talk a little bit about tariffs, the impact that could have on inflation going forward, some of the other policies coming out from the administration. Where do you think we stand in this fight to tame inflation?
Well, I think you start with the data, and the data that we already have had has pretty much leveled off over the last 6 months. That's with both the CPI measure and the CPI data that we just got out recently that had 3% for the CPI, 3.3 ex food and energy. The PCE also has been pretty flat over the last 6 months. So as long as inflation's staying flat at levels that are above the 2% inflation target, it makes sense for them to be on pause regardless of the policy uncertainty. When you add policy uncertainty on top of that, it highlights that you really need to start seeing some improvement in the ongoing data before I think the Fed's going to be willing to seriously consider easing further.
Well, and I thought one of Bostic's interesting notes there was that not only do you have policy uncertainty potentially creating upward pressure on inflation could potentially create downward pressure. I want to play for you what he just said and get your take on it.
I've talked to a lot of business leaders who are quite optimistic about what's going to happen on the regulatory side in particular. And they think those effects may actually swamp what happens in other areas. And so I don't want to presuppose anything at this point. As I said to start, I'm worried about everything, but I definitely want to make sure that before jumping to any conclusions, I see precisely what the policies are.
And of course, Eric, that's the challenge, right? When do we start to see? I mean, we don't even know what, all the complete suite of tariffs at this point. We don't really know the effect of deregulation. When do we start to get some clarity on any of this?
Well, we do have a little bit of clarity. We have 10% tariffs on China. 10% is not a small number. We also have tariffs on steel and aluminum. That's a significant input into car prices, for example. So we don't know how long they will continue to be at the level they're currently at. They could always be dropped. But there have been tariffs that have already been put on. Now, there are additional tariffs that are being considered. That certainly, it looks like the effect from tariffs are more likely to be front-loaded, meaning in the next 5 to 6 months, we're likely to have more clarity, but to the extent that more tariffs are coming on, that probably will happen in the next 6 months. I agree on the point with regulation, but regulation doesn't move very quickly. So usually it requires the regulatory bodies to get together. Sometimes it requires legislative changes. That's much further out in the future. So that has the potential to bring prices down over time. But I think some of the inflationary policies, which would be the immigration policy and the tariff policy, are more likely to hit the economy over the next 6 months, which is exactly why the Fed should be pretty cautious before it decides to undertake further easing. So in the absence of the tariffs and the absence of immigration, I think a pretty strong case would be made that the trend for inflation would be moving down towards 2%, probably over the next 6-month period. But given the policy that's being suggested and some of the policy actions already being taken, I think it's unlikely we're going to see that much progress over the next 6 months.
And Eric, just given that and given so much of that uncertainty, how much of that do you think is really interfering or sidelining some of that global investment and then the cascading effect that could potentially have on the economy as well?
Well, I think it affects both consumers and businesses. So in a world where you don't know whether they're going to be tariffs of a magnitude of 25% or higher, it starts affecting your decisions about what to buy now, what to buy later. And for investment decisions, before you're going to deploy hundreds of millions of dollars to build a factory, you're going to want to know what the tariff policy is and how long it's going to be in place. So if you're serious about trying to get businesses to try to open up factories in the United States, one, you have to think about even with the tariffs, does that equalize the wage differentials depending on what countries they're moving to? And I think you also have to consider whether the tariffs are likely to be permanent or not. If they're not going to be permanent, you don't build a very expensive manufacturing plant in the United States, because then when the tariffs go off, you're going to have a stranded investment in the United States. So I think this uncertainty actually is quite destabilizing, both to business decisions, but also consumer decisions on buying cars, to the extent that China and emerging markets are producing a lot of our apparel, for example. The reciprocal tariffs could have a significant effect on prices for apparel. So I think that uncertainty is likely to be a damper on growth that we would otherwise be seeing.
All right, Eric, always great to get your insight. Thanks so much for taking the time to join us here today.
Thank you.
Coming up, it's the latest edition of our series, Goodbye or Goodbye. We're taking a deeper dive into 2 stocks to help you make the best moves for your portfolio. Stick around, much more market domination still to come.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise, to navigate the best moves for your portfolio. Today, we're taking a look at cyclical stocks, and I'm here with Genter Capital Management CEO and President Dan Genter. Dan, come on down here. Let's talk about your buy, first of all, and that is Chevron, which has been an interesting case. Like a lot of big oil stocks, hasn't really done a heck of a lot over the past year. It's up about 2%. So let's break down why you like it here. First of all, you say there is an inflection point in the free cash flow. What is driving that?
Well, what you're really seeing is that they're in a situation now to where finally their big project that they had in Kyrgyzstan is coming online. And so that was nothing but a liability. Now it's going to be something that it's going to start production. It's going to be significant contribution to free cash flow. And so it really helps them because it was a big unknown as to when that was going to come online. Mm-hmm. So it kind of is back to, they have a good international push. They have a tailwind internationally. And then obviously they're going to have a drill, baby, drill. Tailwind that they're going to have domestically.
Well, is that a tailwind or a headwind? I mean, because if you drill too much, then you end up getting a little bit of...
They have some adverse effect on the commodity.
Yeah,
but,
right.
but I think we have to realize that that's going to take a long period of time. I mean, even the leases are allocated. The permitting process has obviously been a delay. Even if they basically put that in place, I mean, these rigs and various infrastructure doesn't come up overnight. They're also going to have some labor shortages right now and getting people to man the rigs. So all of some additional supply it's going to be basically, there's going to be a tail to that coming on board.
Let's talk about something that's been a big overhang, right? Which has been trying to close the deal with Hess.
With Hess.
Is it happening?
We think it's going to happen this summer. And it's been a huge overhang. It's a big liability. They have huge capital commitments to it. And the fact is, the biggest thing for the stock is not an immediate increase to cash flow like you're going to have from Kyrgyzstan, but what the big deal is going to be that it fills their pipeline literally in the future. Because they're really worried, the market's worried about their properties that they have going into the future. Are you going to have these new reserves? Are you going to have this new inventory? Where is it going to come from? And needless to say, that's a massive, massive field and is used to them to finally put that deal through and try to put some in production.
And then there's another area where we just got an announcement of a deal recently that has to do with putting natural gas power into data centers, which, as we know, has been a huge area.
Well, that's going to be huge because it's a whole AI play. So there's very few situations where literally a raw commodity energy company, utilities company is one thing, but a raw commodity energy company, an E&P company, is going to have a chance to participate in this.
Right.
So now they'll switch over to the natural gas, plugs them right into that. This is going to be major power source utilization, and they're trying to literally have a direct pipeline into it and be one of the first to the show.
Right, and they're partnering with GE Vernova to do that. But let's talk about some risks, though, on the flip side. You could potentially, of course, they're still commodity dependent, right? Even though they are relatively diversified. What's the risk that we could see a pullback in oil prices, for example?
Well, look, if more supply comes on sooner, or you have a reduction in demand because the economy, whether it's caused by tariffs or whatever happens to be, the economy slows, then anything that's going to affect that demand and commodity price, unfortunately, they're a direct participant to that.
Right.
So, and the other risk that, they really have that's just the big overhang, as you referred to earlier, is if the Hess deal doesn't go through.
Yeah. Well, they need the Exxon buy-in for the Hess deal to go through because of all of the parties' interest in the Guyana properties and offshore oil fields there. So, that's the big question.
It's a big overhang, as I mentioned, for the pipeline.
Yeah.
It's an overhang with regards to liability dissipation, and it's a big overhang. So getting it done this summer, we think that the stock is reasonably priced where it is. It's been under pressure, so you get a little pop. And if they get some domestic additional production and moving into the data center type of the business, they have a good future ahead of them. We feel at this price point.
Okay, well, so let's talk to the stock that you don't like as much, and that is Starbucks. And this is a stock that's up about 20% over the past year. Brian Niccol came over from Chipotle to run Starbucks, so there's been a lot of enthusiasm there. But you're looking at potential margin pressures here. What's behind those?
Well, what's happened is he's come over. He's a great operator from Chipotle. He knows what he's doing. He's put together a lot of initiatives in something that's been a little bit of a dead brand. And he's moving it forward, but hey, that comes at a cost. And so what you're seeing is there's some margin erosion that's taking place. So he's going to have, and that's not unusual, but you're going to have to see that he can deliver. And that basically that can go forward. He can push it. And then you're going to have to see a strong increase in what you're going to see in earnings per share based upon where the current PE is. And there's no way around that. He's going to have to deliver, and then showing that has an increase in margins, and the biggest thing is an increase in same-store sales.
And let's also talk about the operating environment. By this, you mean, in part, what's going on in Washington. The new HHS secretary coming in, RFK Jr., who is not a big fan of big sugar.
Of sugar.
Yeah.
No. And look, they've been referred to as sugar, sugar on ice. And so the fact of the matter is they may get some pressure, and you never know where that's going to go. They've been boycotted before. If that picks up momentum and people jump on that and they start boycotting those products, those are high margin products. They're way, way away from just being in the coffee business. So that has to continue to flow and has to continue to expand. And if they get a lot of pressure on that, it's going to be a roadblock for them.
And then there's where the stock is trading, which is above its historical trading range with that sort of breakout that we have seen. So do you think it's expensive then, given some of these?
It's definitely expensive.
Yeah.
It's at a 35 PE, based on what we're looking for in 25. It's relatively high on a relative basis for itself, just because, as you mentioned earlier, the stock's had a big pop. And it's jumped. And so now it's trading basically on good news. I wouldn't say it's trading to perfection, but it's trading on a lot of happiness. Maybe it's a sugar high, but now they need to produce and make it go forward.
So let's talk about what could get you back in just briefly here. If the valuation comes down, makes sense there, or you get some other types of operational or turnaround in the business?
Well, valuation has to come down. We think for us to move in and on a heavier position, the valuation has to come down. And you have to have some margin predictability, because you don't know, is the current run rate of what they're doing with expenditure is going to be enough to do it? Or if he has to, he's going to double down, to drive the top line. Same store sales in this business is everything. So they have to be able to push it, and you're going to have margin erosion, or we want to see some predictability.
Gotcha. Okay. Well, thanks so much for being here. And just quickly, positions in either of these names?
We own Chevron. I own it. The company owns it. My family owns it. I think my dog owns it. And the Starbucks, we have it in one fund that the company owns. I don't own it.
Okay, Dan, thanks so much for being here. And thank you so much for watching Goodbye. We'll bring you new episodes at 3:30 p.m. Eastern.
Now time for some of today's trending tickers. And first up, we want to take a look at Hims & Hers Health. Those shares are soaring once again today. This time it comes after the company announced that it had acquired Tribe Labs. Now the deal will allow the telehealth company to offer at-home blood draws and more comprehensive pre-treatment testing to its users. Again, the street reacting very positively to this acquisition. You're looking at shares up just about 16% here today. You're looking at a gain of about 12% over the last 2 days. But again, what is this going to do? Hims & Hers will now offer 70 at-home diagnostics tests. It also puts them into competition with a name like Quest Diagnostics with LabCorp. But once again, Julie, this is a stock that we've talked about time and time again. Certainly has gained a lot of momentum, especially even over the last couple of weeks since the Super Bowl ad. But obviously, a lot of that recent momentum tied to their weight loss drugs and the alternatives that are out there for Novo Nordisk and Eli Lilly.
Is this stock up today so much because it bought this company?
Maybe.
Could be. But it's also up 190% this year without any actual real news. The company doesn't even report earnings until February 24th. But you know what it does have? A heck of a lot of short interest. Just like some of the other names we've been talking about, this has been fueled, at least in part, undoubtedly by a short squeeze. Once again, we have this data from S3 Partners. So the total short interest, $3.44 billion, an increase of $1.84 billion over the past 30 days. And that losses on the right there of $1.92 billion, that's the squeeze. The people who have had to cover their shorts, further driving the shares upward. So this is one of those. I mean, yes, obviously they have a business that's popular. They're the only publicly traded platform that does what they do. Does it justify a 190% increase? Well, I'm not talking 12 months. I'm talking since the beginning of 2025.
Well, exactly. And then you take a look at the 12-month chart, and that's near 600% increase, right? So that also just speaks to the staggering amount and the velocity at which we have seen the stock rise. A lot of that, you're right, is because of that short interest. And when you take a look at whether or not it can actually maintain that momentum without a significant improvement in fundamentals, that certainly is going to be put to the test.
We'll see.
We'll see.
All right,
Time
let's
will
talk.
tell.
Should we talk about dating apps now?
Let's do it.
Let's talk about Bumble. That stock getting smoke today after the company announced fourth quarter earnings, issuing a weaker than expected first quarter outlook as well, and revealing it lost 57,000 paying customers in the fourth quarter versus the third. The company also announced it would be sunsetting a couple of its apps, Fruits with a Z and Official, two apps that it had acquired in order to cut costs. And the move coming as Bumbles and others in the dating app industry have been grappling with financial challenges, prompting a reevaluation of their business strategies. As one analyst pointed out, I think the folks at Jefferies, the outlook that the company has just given implies 14 straight quarters of Bumble app revenue growth decelerating. If you look at their overall revenue growth, it's just decelerated quarter after quarter. It's been slowing.
Yeah, exactly. That line and that statistic stuck out to me. And then also the folks over at Piper Sandler saying that the turnaround is going to be choppy. When you take a look at the fact that there's no clear, I guess, conviction in terms of that direction. You talk about the fact that there's certainly been a lot of management changeover. You also have the return of Whitney Wolfe Herd. She's returning as CEO next month. And you talk about the changes that have already taken place. The company obviously has looked to cut costs. They've laid off a number of their workers within the last 12 months as well. So again, when you're talking about the fact that we've seen this deceleration in growth, obviously that's never something anyone likes, especially when you take a look at the street. And there's a lack of catalyst, I think, is the clear message that's coming from Wall Street.
You know what I always hope when we talk about this? That people are meeting each other organically in real life again.
I know, but it seems like that's happening less and less.
That's like my happy married lady, sunny view of things.
Maybe by the time our kids are looking to me, their long last loves, that will happen.
Right, coming up, Apple has debuted its latest iPhone for a lower cost. We'll get you all the details on the other side. Stick around, much more market domination still to come.
Apple debuting its iPhone 16e. The budget-friendly iPhone includes Apple Intelligence and its first in-house designed modem. So naturally, we're calling Yahoo Finance tech editor Dan Halley joining us here at the desk. Dan, I think there's a lot to be excited about within this new product. What do you think?
Yeah, I mean, this is really kind of the predecessor to the iPhone SE line. And so that was really the kind of entry-level iPhone that Apple had had for so long. They're doing away with that now. They're doing away with the iPhone 14, I believe, and now this is going to be the base iPhone that you can get. It starts at $599, which is a little more expensive than the old SE. That was $429, but you do get a lot more out of this. The phone itself, which is available February 28th, comes with the latest chip that Apple has for the iPhone 16 and 16 Plus. It's not the same one that would be in the Pro or Pro Max. It's the A18 chip. The important thing here is that that enables Apple Intelligence, which is the AI platform that Apple wants to get everybody hyped on so that they'll continue to upgrade or start to upgrade more than they have in recent years. One of the other things to point out with this phone is that it has Face ID, which is Apple's facial recognition, something that wasn't on the prior SE. It also uses USB-C charging, and it has a single camera on the back, but has a kind of 2-for-1 camera option where you get a 2x kind of telephoto-like zoom on the back. It's also got a 6.1-inch OLED display, which is frankly really nice looking for a device at that price. So I think this is really something that Apple is going to be seriously pushing, and something that I think a lot of people will consider as a potential upgrade, especially now people are thinking about pricing. We're looking at the potential for tariffs and maybe an impact to phone sales there. The other major thing to point out with this phone is it's also the first to come with Apple's in-house design modem. So it's called the C1 chip, and it takes over from Qualcomm. This is all part of Apple's plan to make everything kind of in-house, so they're totally vertically integrated, and it allows them to get more power efficiency out of it, but also lets them be more flexible on the design of the iPhone. And there's talk of them coming out with a thinner iPhone next year, or I guess later this year, and the potential for a foldable one down the line. The big question is, what's the performance like compared to the phones running Qualcomm's chip, and will it offer the same kind of speed and capabilities? It doesn't offer what's called millimeter wave 5G. It does have 5G, but it's just not the super duper high-end millimeter wave that other phones that have the Qualcomm chip have. So we'll just have to see what the performance is like. It's difficult to say whether it'll be an apples to apples comparison, though.
No pun intended. Let's talk about another chip, the quantum chip race. Microsoft is now out with a new quantum computing chip, and they also sort of reset the whole timing discussion around quantum. What can you tell us about it?
I want to make a Scott Bakula joke about quantum leap, but I don't know if anyone else will really get it.
I would get it.
All right, perfect. Yeah, I mean, this is their new chip that they're coming out with. It's the Majorana 1 quantum chip, and essentially this just heats up the quantum chip race that we're seeing kind of break out now. Google had announced their own Willow chip back in December. The big deal with this is that it allows for more qubits to be used in the process. Qubits you can think of as kind of similar to bits on a regular chip. Those are represented as ones or zeros, but because of quantum mechanics, qubits can be both 1 and 0 at the same time. So it allows for these kind of super high-end calculations that would take thousands of years for a regular computer to process. Doesn't mean that you would plug one of these into your house. This has to be near absolute zero temperatures. It's a very specialized machine. But yeah, you're right. They did kind of talk about the timeline for when we would see practical use cases for quantum computing in the real world. Now, there was talk previously from Sundar Pichai saying 5 to 10 years, and then NVIDIA CEO Jensen Huang said, well, it's probably more than that, maybe 20 years out when we'll start to see that. And now we're seeing this, back to the 5 to 10 year range with Microsoft. So look, it's truly up in the air. I think when it comes to technology, it's very difficult to predict timelines. I can say from personal experience, I was at CES, the Consumer Electronics Show, years and years ago when car companies were saying, oh yeah, 5 years we'll all be sitting in cars and falling asleep while they drive us around.
Right.
Didn't exactly happen, so we'll just have to see.
Yeah.
We'll see what that timeline looks like. All right, Hallie, great stuff. Thanks. Well, we're wrapping up today's market domination. Don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime. We'll be right back.
There's the closing bell on Wall Street, and now it's market domination overtime. So let's go check on where the major averages ended the session. The Dow a little bit more in the green, up 0.1%, 71 points, still not huge. The S&P 500, though, with its gain on the day, did manage to close at another record for the second day in a row. It also actually touched an intraday record over the course of the day. Didn't quite close at that intraday record, but still higher on the day. And then the Nasdaq up very slightly as well. I wanted to take a look at what went on in the bond market today also, Shauna, because we did hear, first of all, we got the Fed minutes from the last meeting, and we heard from Raphael Bostic talking about all of the things that the Fed has to weigh right now.
Yeah, and you're talking about how much uncertainty there is right now when you compare tariffs, when you compare some of the inflationary potential policies, and then you compare that to some of the policies that could be rolled out from the administration that could be deflationary, and how complicated the road is ahead here for policymakers right now in making that next decision and what exactly that timeline is going to look like. I think a lot of the fact that we'd had more of a muted reaction to the Fed minutes was nothing was too surprising, right? Very much policymakers are still waiting to see further improvement in inflation. That has very much been clearly communicated from Powell in the past and very much clearly communicated from a number of the policymakers that we've heard from here over the last couple of weeks. When it comes to today's action, I think very much we are seeing reason for investors to keep buying. We're seeing that clearly reflected in the fact that the S&P closed at another record high, but also that broadening story that we have been talking about. That was clearly reflected in the sector action that we saw today.
Yeah, let's take a look at the sector action real quick, and then I want to come back to some of the trending tickers and just like the big moves that we've been seeing in individual stocks. But here's the sector action. Healthcare actually leading gains today, up 1.25%, along with consumer staples and energy. Materials falling today, led down by a company called Celanese, chemical company that came out with its results. But going back over and taking a look just quickly at how some of the trending tickers of the day closed, it just shows you again some of the big moves here. And some of this is short interest, right? And I believe our Josh Schaefer just wrote a story about the big short interest and the big short squeezes that we have seen. Supermicro Computer, one of them. Adam Johnson at the top of the show saying he likes this company fundamentally, but he doesn't mind that it's getting short squeezed. It's up 8% on the day. Hims and Hers, as we talked about, yes, bought a home blood testing company, but the stock is up, as you said, 600% over the past year, up another 18% today. Celsius up 15%. I don't know that there was anything in particular. So just, you get an idea here. Yes, SolarEdge did come out with earnings, but a lot of this stuff is people once again looking for these little opportunities.
Yeah. Any reason to remain optimistic here. Yeah. All right, well, another muted day of action on Wall Street to a certain degree, but the S&P 500 notching another record high. Our next guest is saying that markets, though, are taking on a mentality to sell first. And we're seeing this year is already trickier than it was just last year in 2024. We want to bring in Dave Mazza. He's Roundhill Investments CEO. Dave, it's great to see you again. So walk me through that thesis there, what you think maybe that signals about the days and months to come.
Yeah, no, we believe that we're in a stage of shoot first, ask questions later. Of course, we're in the third year of a bull market. There's still a lot to be excited about from the economy and job growth and inflation generally coming down, but still being pretty stubborn. And then earnings, which actually were decent, if not to good, depending upon your perspective. But the challenge is that because of the amount of uncertainty that has increased, investors are taking any bit of bad news really poorly. And because they want to protect the gains, the historic gains they've had over the last 2 years, are willing to sell first and then ask those questions later.
And yet the S&P 500 closing at a record high, Dave. And this gets to kind of something I've been noticing recently, which is there seems to be a vibe and action disconnect, right? There is that sort of attitude you're talking about people being jumpy, and yet stocks at record highs. So how are you thinking about that sort of seeming disconnect?
Well, no, it's interesting, right? So I think markets are climbing another classic wall of worry. We're making new all-time highs almost every day, but there's a lot of questions that come with it. And I think you're absolutely right. Before we got into the current state of the market, especially with the questions about tariffs and then what's the Fed going to do about these inflation numbers that we're seeing, is that was really kind of a vibes market. And maybe we've been in a vibes market and economy for a long time. And so I still think particularly retail investors are positive on stocks, positive on the markets. Vibes are good, but the market's become fragile. And some of that's normal, right? Again, 3 years into this bull market, but this fragility has been showing some cracks. Look at the misses on cloud revenue from Amazon, Microsoft, and others. Those stocks were really punished, but at the end of the day, they were growing at 30%. especially on massive numbers. So normally you would say, all right, well, this is generally a positive, but investors have become so accustomed to quarter in, quarter out, these big companies, especially whether it's the Magnificent Seven or the hyperscalers, spending and growing. And if that growth is slowing, I think it's getting harder for people to continue to pay up for multiples where they are right now.
So Dave, what does that mean then for positioning? How should investors then be thinking about the opportunity as it stands?
Well, it's interesting. One of the things that we've been thinking about for investors who still want to be exposed to the market is covered call strategies. So you can still maintain some upside with a covered call. Of course, you're capping it, but you're using this uncertainty and the increase in volatility, which we think is going to be the norm, not the exception, to harness that volatility to provide you income along the way. So it's a way to still be exposed to the market, take a little bit of risk off the table, and do so with reducing the overall volatility of a portfolio.
And how are you thinking about the Mag 7 right now, Dave? Because we've obviously seen a lot of dispersion within the Mag 7 this year. We've not seen them collectively leading the market like they had been. I know that's something you pay attention to. So what does that portend for how the overall market's going to perform?
Yeah, I think last time I was on, I was still kind of pretty bullish on the Magnificent Seven because of the earnings expectations that we were continuing to see. And what ended up happening was those stocks, especially if we think back to the end of last year, which now seems like not months ago, but years ago, they just were ripping higher on a daily basis. And so their multiples expanded. They essentially, their multiples expanded so much that their earnings growth looking forward is not as attractive. And so while we're still positive on those names, we're definitely a bit more cautious. One of the reasons why we think a covered call approach can make sense. Of course, the NVIDIA earnings are going to become the new make or break element. NVIDIA earnings have become a macro story along with CPI and the jobs report. And I do think if we see a smidge of disappointment there, because then the stock, of course, will get hammered in this sell first mentality. But it hasn't really been trading that great thus far to begin with. And so perhaps actually if we see just some okay earnings, if not good, then I think the market could probably be propelled higher.
Dave, I guess when you take a look at the fact that we are seeing this fading performance here within some of those larger cap tech names, I guess the question is to what degree then does that maybe diminish the appeal of U.S. stocks and boost maybe the appeal of some of that international opportunity?
Yeah, one of the other interesting elements that we've seen is everyone was calling, if we remember last year, for the great rotation from growth to value, from large to small. What we're actually starting to see is a rotation from the U.S. to the rest of the world. We know the non-U.S. markets, whatever one you might want to pick, broad-based benchmarks, individual countries, have really suffered, and they've suffered for good reason because economic growth and earnings growth just wasn't there. If you look at just do a decomposition of the European market to the U.S. equity market, the sectors are vastly different, much more cyclical, not as much of this excitement from tech. And I still think the idea of U.S. exceptionalism still has some legs. And probably will, after we sort of get through this uncertainty, especially on the trade side and tariff side, could continue to be supportive for markets. But investors are rightfully looking for other opportunities. And at some point, even with the uncertainty on the tariffs, it just gets too easy to go pick up some beaten down names in some areas that may actually be propelled higher if you believe that the tariffs are really more of a negotiating tool, which they to date seem to be the case, versus really going to be put in place very broadly, very harshly, and almost indiscriminately.
And then, Dave, we also have this sort of like meme feeling bubbling up a little bit, it feels like this year. You know, we were just talking about hims and hers. We're seeing some short squeezes seemingly make their way into the market here. Does that tell us anything about the environment right now, or sort of the willingness of investors to speculate at the moment?
Well, those are your vibes, right? And they're still there, right? It's interesting. So, you know, the OG memes, your AMC, your GameStop, those names, of course, have their lovers and then their haters. But memes have sort of expanded, right? So some people would put a Palantir in that camp, even though they have, you know, a pretty robust business. The stock, of course, was a bit hammered today on some of the spending news out of the government. But the idea that some of these more speculative names, quantum computing, and others. Hims is another great example, can continue to rip higher, at least shows us and shows me that there still is a lot of positivity in the markets. People don't want to be bearish, but at the end of the day, fundamentals do matter, but right now they are certainly mattering a lot less for some of those names in question.
Yeah, Dave, great to see you as always. Thanks a lot.
Thank you.
Coming up, we'll get to the latest earnings results from Carvana and Toast. Plus, we'll hear from the CEO of Travel and Leisure Company following its latest results. Stick around, much more market domination over time coming up. Let's take a look at shares of Toast, the restaurant software platform releasing its fourth quarter results. And it looks like the shares went up and now are down by about 3% here as investors try to digest what we heard from the company. So overall, the numbers looked relatively good at first glance. The company says fourth quarter EBITDA was at $111 million. That's ahead of the $100 million or so that investors were looking for. Fourth quarter revenue, $1.34 billion ahead of estimates. And the company coming out with some forecasts as well, saying first quarter adjusted EBITDA will be $100 million to $110 million. That whole range is above what was estimated. 2025 adjusted EBITDA, $510 to $530 million. Again, the whole range ahead what was estimated. So not sure exactly what's going on with the shares here. It's not like they were roaring up into the report. The shares are up about 10% this year. They are up almost 80% over the past year. But nonetheless, we'll dig in a little bit and see perhaps what was going on here.
Yeah, exactly. Even taking a look at some of the commentary within this release, the executives saying that our record location ad showing that the momentum within the core customer base, there's a lot to be excited about there. Some of the positive signals across from their even newer customer groups. When you take a look at enterprise, when you take a look at international, food and beverage and retail, also talking about some of the gains that they are seeing there as well. So again, it is a bit perplexing that you're seeing a drop here of just about 3.5% in shares, especially given the underperformance that we saw leading into this report, at least on the day. But again, when you take a look at the most recent quarter, at least when you compare it to expectations, it does look pretty solid here across the board. And like you noted, shares did initially climb.
Yeah, so we'll dig in here and see what is going on. In terms of that record number of new locations the company added, it said it added a record 28,000 net locations that are using the Toast platform. So again, we'll dig in here and see what maybe could be going on.
All right, in the meantime, let's take a look at shares of Carvana. Carvana just releasing its fourth quarter results, and you're taking a look at that stock off just about 5%. So again, some selling there. When you take a look at these numbers, at least at face value, revenue for the fourth quarter beating the street's expectations, coming in at $3.55 billion. The estimate was for $3.34 billion. EPS coming in at 56 cents. The number of vehicle units sold coming in at just over 114,000. That was also better than what the street was looking for. The company giving some guidance here. Maybe this is a bit of a reflection of what we're seeing here in the after hours market. But again, overall, they are expecting some profit growth in 2025 following that record quarter that they did see. They do expect to see sequential increase in retail units sold in the first quarter. They also went on to say that they also expect to see a sequential increase in adjusted EBITDA in the first quarter as well. But again, you are looking at shares under a bit of pressure. It is important to note just the outperformance, though, that we have seen overall over the past several months in Carvana stock as this company has embarked on this turnaround strategy.
Yeah, I think your theory that they didn't give a more specific forecast as the potential reason behind the shares dipping, that is a good theory. The company, just giving a few more of the details here, over the full course of the year, the company selling 416,348 retail units, i.e. vehicles, which was a 33% increase here. And the company talking about and sort of touting that in terms of the number of cars they sold and the EBITDA from the company. So we'll keep tracking it, see what's going on in terms of the shares pulling back and whether that share pullback does stay. But the shares have just enormously soared over the past year. So we have to put that in context as well. Yeah. Well, travel and leisure company reporting its fourth quarter results earlier today, beating on the top and bottom lines. Here to help us break down the report, Mike Brown, Travel and Leisure and Company CEO and President. Mike, it's great to see you again. So for folks who are not familiar with Travel and Leisure, who haven't seen you on the show before, largely a sort of vacation club timeshare business, the bulk of your business. And so you guys provide a pretty good window into what's going on travel-wise, right? So just give us sort of high level what you saw in the quarter and what kind of demand you're continuing to see.
Well, it is great to be back with you and appreciate always the opportunity to tell our story. What we saw in the fourth quarter was an acceleration in the final 2 months of the year as we headed into the holidays. It seemed that real close after the election, there just seemed to be, whether it was the elimination of uncertainty or just a change in the overall confidence, it really propelled us to a very strong fourth quarter where we beat expectations, as you mentioned. I think most importantly for us is that momentum hasn't stalled at the year end. We've continued that success in the first half of Q1. And ultimately, we get a daily check on how consumers are thinking about vacations in one of our key statistics called volume per guest. And that remains at an extremely high level for us, more than we expected as we came out of the pandemic some years ago. It shows that people see value, they want to get on vacation and the type of vacation we offer, and that there doesn't seem to be any cracks in the consumer confidence from our standpoint.
Mike, what is volume per guest? That was a metric that we were looking at, in the statement, in the conference call. Explain to us what it is.
So think of it's our version of hotel RevPAR. For every guest that we see, the amount of money they pay for additional ownership of timeshare vacation ownership. So if we see 10 guests and we get $100,000 of revenue, it's simple division that it's $10,000 volume per guest.
Mike, you mentioned consumer sentiment as a macro level indicator on your call, and I bring that up just given some of the trends that we've seen, especially the most recent report when we got the fact that people are getting a little bit more worried about inflation. What does that mean for your business?
Well, this may strike you as a bit odd, but inflation has actually been a big propellant for us in the last 3 to 4 years because 7 out of 8 of our consumers have fully paid for their ownership, which means they're vacationing with dollars that they spent 3 years ago, 5 years ago, and 10 years ago. So imagine if you walk into a hotel and said, I want to pay the 2015 rate for my nightly stay. That's what we offer in vacation ownership. You're prepaying your future vacations. And since everyone has a vacation budget, people have purchased with us. They already see the value. They love the vacations. Economically, it's good for the pocketbook. And ultimately, they know that when they're coming to see us, and it encourages them to even buy more.
What about new timeshare owners in this environment? And how many of those folks finance, right? Is that an option that you provide? And how much of a headwind then are higher rates?
So it's a great question in the sense that most of our consumers purchase, the percent finance is roughly 60% of their purchase. And what we tend to find is it's not about the actual full price of their ownership. Everyone has a vacation budget throughout the year. And as long as their monthly payment fits within their budget, they see the value of vacationing in 1,200 square feet. As it relates to interest rates and what that means for us, higher for longer is what we're hearing. And that simply means that 3 times a year, we'll take our portfolio of loans and access the asset-backed security market. So if they stay higher, it squeezes those margins just a bit. But ultimately, we've seen those come down over the past year. And it shouldn't be a headwind for us this year unless they do go back up, or at least a marginal headwind if they stay flat. But I think most expectations are one more cut this year, which means they shouldn't be a headwind against our business this year.
Mike, are you seeing any change in consumer travel plans, especially when you compare the higher end versus maybe the lower end, and obviously that willingness to spend in this macro environment?
Well, I'll look at 3 or 4 different factors to see if there's anything meaningful. And let me share a few of them with you. I think more broadly, this whole work from home environment has really extended our length of stay over the past 5 years. That trend is not abating. In fact, this weekend, I saw Carvana on previous to this segment. I was over at the Daytona 500, went over Friday, worked from our condo all day Friday, and then watched the Carvana car end up third on Sunday. So first of all, length of stay getting extended. We also watch for booking windows. They're consistently 120 days out. When people get more certain, they shrink to 90 to 80 days, but we're not seeing that. And lastly, we often see shifts from air travel to drive-to as people conserve cash. Again, we're not really seeing any changes in those trends as well, but I can assure you that as the year progresses, we'll check in on those statistics every month or so and see if there is any crack showing in the consumer confidence.
Yeah, it's interesting, Matt, because you talked about that sort of surge in enthusiasm after the election. It feels like, at least from a market perspective, even though we're at record highs again, but it feels like from a sentiment perspective that's wavered to some extent because of things like the threats of tariffs and the back and forth, the things like all of the cuts in DC and those workers affected. Now, you mentioned those different metrics that you have. Are there any other ways? Are you seeing, fewer new buyers, for example, come into the market?
Well, you bring up a good point about the cadence that's come through the pandemic. What we saw is in 22, those all came back to hospitality. And then it seemed like everyone went to Europe to make up for lost time. And then it was cruises. The way we see it today is people have really returned to the norm of, majority domestic travel, occasionally international, back to a good balance between cruise and us. But again, we're watching for forward indicators, and macro often drives that, whether it's interest rates, foreign exchange is keeping people considering Europe this summer, which we have a lot of destinations in Asia. But again, the strength of the consumer as we sit here in mid-February hasn't changed, but there's no doubt we're watching for if unemployment moves up, how does that affect us? And usually we'll start to see that in volume per guest, what we talked about earlier. And that shows up every single day in our KPIs. But again, it's great to be toward the end of February, showing really strong momentum as we head into the last month of the quarter.
Gotcha. Mike, good to see you. Thanks for joining us.
It's great to be back with you.
It is time now for What to Watch Thursday, February 20th. Starting off on the earnings front, some big names reporting tomorrow, including Walmart, Alibaba, and Booking Holdings. Walmart will announce results for the fourth quarter before the opening bell. Analysts expect the retail giant to expand on its robust holiday season, driven by more engagement by higher income households.
Taking a look at the Fed, another batch of Fed commentary coming throughout the day tomorrow, including Chicago Fed President Austin Goolsbee. Now, this follows today's comments from Atlanta Fed President Raphael Bostic. Bostic telling Yahoo Finance that he's not taking anything off the table when it comes to interest rate cuts at the next Fed meeting.
Moving over to jobs, weekly jobless claims data coming out in the morning, and economists forecast the number of claims will tick up compared to the week prior to 215,000. We have seen unemployment spiking in Washington, D.C., as Elon Musk and the Department of Government Efficiency continue efforts to shrink the federal workforce.
Well, that'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern Time for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned. Hello and welcome to Asking for a Trend. I'm Julie Hyman, and for the next half hour, we're breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we'll be diving into. Another roller coaster day for the markets, even if in a tight range, with each of the major indices managing to sneak into positive territory just before the bell. Maybe a kiddie roller coaster, with the S&P 500 notching a fresh record high. We'll dive into the rest of today's market trends as well. Then, if you're trying to figure out what the Fed will do next, should you be ignoring what the central bank actually says? We'll explain. Plus, as Elon Musk's Doge works its way through the federal government, what impact will thousands of cuts to the workforce have? We'll speak with a former congressman. Well, according to Fed meeting minutes released today, Federal Reserve officials in January agreed that they would need to see inflation come down more before lowering interest rates further, and expressed concerns about the impact that President Trump's tariffs would have in making that happen. Our next guest, though, says if you're trying to figure out what the Fed will do next, pay attention to the data, not those individual comments necessarily. Joining us now, Jerome Schneider, PIMCO Head of Short-Term Portfolio Management, here with us in the studio. Thanks for being here.
Hey, good afternoon.
So when we, obviously we obsess over Fed speak. It's what we do as people who watch the markets, right? But the Fed itself says we're watching the data. So does that mean we should sort of put the commentary to the side and also watch the data?
Yeah, the commentary from the individual Fed speakers can be elusive at times. And what we're thinking about in this current environment is sort of the intersection of data that comes forward from growth, data which comes from inflation. And really, that prescription was made clear today by the Fed minutes, where they're going to sort of take a pause, see where the economy evolves, and more importantly, what happens to the monetary policy in the medium term. So individual comments, while important to sort of get a flavor for the ingredients that the Fed's considering, won't necessarily lead to an output. It won't necessarily be a baked cake in the near term. We need to be thinking about where the Fed's going to do, and quite clearly, they're going to be relying upon the optionality of simply having a Fed statement, having Fed minutes, which gives them that optionality over that medium term.
Right, and effectively what they're saying is they don't know what effect all of the fiscal policy coming down the pike is going to have on inflation. And so if they're waiting, we kind of have to wait on that front as well.
Investors, the Fed, a lot of participants would like a crystal ball to say, here's where the destination is. And quite honestly, it might take some time for us to get to that destination. The reality is that fiscal policy is something that's going to be contended with in the short term. We're clearly seeing the administration go after some areas in that regard. But longer term, we're still waiting to see the effects on the fiscal outlook longer term. And there's going to be some points of interest on this in several regards. Number one, the fiscal policy with regard to revenue increasing. Tariffs obviously is an income to that balance sheet. On the second hand, if it comes into consideration later on this year, tax cuts obviously a negative. And how it all comes to fruition, the timing may not exactly be so prescriptive, so precise that we'll simply say the Fed's going to need to ease or perhaps even raise rates in the future should inflation be stickier. So for investors, we find ourselves at a very unique point in time. Risk assets are nearly priced for perfection, especially when you look at equity risk premiums. Second thing to look at is if you look at the forward rate expectations, the dividend expectations for equities, for the first time in a few years, they're actually lower than bond yields. And that puts us in a very interesting environment where perhaps taking additional risk in the form of equity spreads, credit spreads, things like this may not necessarily be as incrementally beneficial to portfolios. It might actually bring more volatility to portfolios. So it's just something to consider as this outlook, and more importantly, as the Fed continues to be on this glide path for a while, that we need to be considering as investors in terms of our portfolio construction, focusing on a little bit less volatility that could potentially be emanating from your portfolios.
So that's one potential tactic. But I'm interested in your purview as short term.
Sure.
Because as we've been talking about and sort of gesturing at, short term is really tricky right now. I don't envy you trying to figure that. I mean, first of all, how do you define short term? And what do you do short term given that there is so much uncertainty?
For PIMCO, we think about short term as capital preservation. Think of the yield curve as the 0 to 5 year space. So that's relatively short in bond terms. But what's interesting about the current environment is that the short-term environment, rates have gone up over the past few years, but they're now peaking and coming down. From a personal and individual perspective, and even if you're a corporation, there's a unique stratification going on within the rates you can earn in cash now. We've seen, if you go look at your sweep accounts and your individual investment accounts, they could be as low as 5 basis points, close to 0%. And other places with savings deposits, you'll find yourself in the situation that you're not earning near the Fed funds rate of 4.25%. It could be 2 to 3%. So simply staying invested in how you manage your cash And focusing on that is incredibly important to performance these days. So as people still continue to seek safety in this environment, we want to be very cognizant of how they're doing so. And bond yields as a whole can do that. Having some interest rate exposure helps to prevent that left tail risk and create some capital appreciation in owning bonds. But if you're simply going to take the alternative and it be in that wait and see crowd, you might want to see and focus on how you're putting that cash to work.
Not all cash is created equal. And then finally, I want to ask you about international exposure, because on the equity side, we've been having a lot of conversations with people who are looking outside of the U.S. for the first time in a while.
Right.
Is that happening on the fixed income side as well?
It's a very unique environment. And what we're finding ourselves is now that we're past the global financial crisis many years ago, and we're finding ourselves past the COVID crisis, the policy responses from monetary policy entities around the world are very different. So what that ultimately means for investors is there's a divergence in interest rate policies, whether you're looking at the Bank of England, the European ECB, the Australian central banks. These are all central banks that are being much more active in cutting rates than the United States. And as a bond investor with a global outlook, that's creating unique opportunities for relative value trade, something we haven't seen in quite a while. But again, for an investor focused on their portfolio, focused on safety, simply focusing on savings accounts, where those are, and more importantly, optimizing into a shorter bond portfolio can be worth a couple hundred basis points or percentages to their investment. So there are some good places to hide out, and the safety is your concern. Finding some income in bonds is definitely a place to be, at least for the near term, until we get some clarity in terms of the economy and growth.
Jerome, as a bond guy, I expect bond guys to be pretty pessimistic. You don't sound very pessimistic, but I am curious what the biggest risk that you're watching out for is.
Yeah, without a doubt. One of the things that we're finding is that, let's contextualize the conversation here. Growth is still 2% right now. It could be on the upside if certain things happen. It could be on the downside also at the same time. And unless you have a very bullish view and that crystal ball says green, the reality is that outlook is a little bit more clouded. From that perspective, the euphoria that we had in the fourth quarter last year with growth has come off the boil a little bit. Yeah. So don't take me as a bond bear or a negative person, but we are simply saying there's probably a little bit more volatility out there than the average market participant is suspecting. And in that means simply let's embrace a portfolio that's a little more diversified at this point in time. And when you put that into context, earning yields and returns of 5 to 7% isn't an outlandish assumption for having some fixed income in your portfolio. That might be very different than having a high-tech stock portfolio, obviously, but that's the context we're thinking about right now, given the outlook, given how policy is going to be evolving, and more importantly, given the uncertainties not just with regard to monetary policy, but also geopolitics. There's a lot of factors out there. So we are cautiously optimistic on the economy. We do think that there's potential for additional rate cuts from the Federal Reserve this year, but the reality is that that's probably evenly balanced, and that outlook could be moved in one direction or another pretty easily over the next 6 months. So for the time being, we need to be focusing on that portfolio construction and that income generation.
Gotcha. Jerome, thank you so much for coming
Great
in.
to be
Really
here.
appreciate it. Well, U.S. stocks closing higher, the S&P 500 closing at a new record. Investors weighing tariff fears, digesting the latest Fed minutes, all of it equaled an actual gain. Yahoo Finance's Josh Shaver joining us now with the trading day takeaways. Hi, Josh.
Hey, Julie, another record for the S&P 500. So we had Fed minutes out at 2 p.m. today. Those were minutes from the January meeting, and largely they didn't shake the market. We actually saw a little bit of a rally after the minutes came out. So I'm just going to take a look at sort of what we saw in the bond market in the 10-year Treasury yield post those Fed minutes. And really, we actually saw the 10-year move a little bit lower. I don't know if I'm going to make too much out of this move here. There really wasn't a ton of reaction to the minutes.
Yeah.
And I think that's largely, Julie, because what we saw was more of what we've already been hearing from the Fed, right? We're in wait and see mode. They're talking about tariffs. It's part of the outlook here. They're assessing where it's going to go. But I think one thing that was interesting, I spoke to a portfolio manager in fixed income over at BlackRock after the minutes, and what he told me was really the key here is the market bias. As long as the market, or really what the market believes the Fed's bias is. If the market believes the Fed's bias is to cut rather than hike, we're sort of in this comfort zone as far as where the 10-year is going to go and then what that would do for stocks. If we start talking more about hikes, if any of these minutes come out and we feel like that's really a part of the conversation, then maybe that's when we start to see more commentary from the Fed start to shake markets. Feels like we've been pretty steady for a while now.
Or unless we get more inflation data that's
right, yeah, it's
really
inflation
high,
data, so then what does that mean for the Fed, right? But for now, it's been a little bit steady Eddie.
Yeah, what else we got?
One other takeaway that we have sitting here, The lag 7.
The lag 7.
The lag
Did you
7.
do that, or
Oh,
somebody
well,
else? Did you borrow that from
some other
somewhere?
people have done it. I'll give credit to
I like
Michael
it.
Hartnett over at Bank of America, who
I like
started the Magnificent 7. He's been calling it the lag 7 a little bit. But what we have here is a chart from our friend Liz Ann Saunders at Charles Schwab. And what this is looking at, Julie, is ranked returns in the S&P 500. So NVIDIA here was number 2 last year, right? What that means is they were the second best performing stock in the S&P 500 in 2024. What we have on this side is where they rank in 2025.
Oh, wow.
So
Love this.
notice we had 3 Mag 7 in the top 30 in 2025 or 2024. We had 4 in the top 100, 5 in the top 100. Look at where we're at now.
Wow.
You can only find 1 stock in the top 20.
We know what it is.
That's Meta. We've talked a lot about that one. And the rest of them are actually doing pretty remarkably not that well, which I thought sort of stood out to me. And we've been talking about this a lot, that the Mag 7 aren't really leading this rally, but this just sort of stuck out to me as something that's going on.
Well, and it was really interesting just talking to Jerome Schneider of PIMCO, who is a fixed income manager, but talked about in this choppy, uncertain environment, the appeal of getting 5 to 7% returns in fixed income in an environment where it doesn't feel like there's any guarantees at this point, even from the such consistently reliable performers as
Yeah, but
something
we're
like
at the
Mag
point
7.
where fixed income is a competitive asset, right? As our friend Yurin Timmer always says over at Fidelity.
Yeah.
When you get up to close to 5% on, say, something like the 10-year, it's a competitive asset with risk assets. So where am I going to put my money? There's other places to put it. Our final one, people
I
are
love
finding
this one.
people are finding some fun stocks to put their money in, Julie, that are going up a lot. So I reached out to S3 Partners to ask about some of the stocks that are often on our trending tickers page. We take a look at, say, Supermicro Computer. Let's go to year to date and let's look at this big gain. That stock's up 97% this year. It's the leader in the S&P 500. But S3 Partners told me it's also one of the most heavily shorted stocks in the market. So a lot of what you're seeing here is just giant short squeezes.
Yep.
Investors need to eventually pay, right? Once they lose on that short, they have to buy the stock. That sends the stock higher. So Supermicro investors have lost over $2 billion on this stock just to start the year. Hims and Hers also.
This is quite a year-to-date chart.
Is up 184% this year. Again, a heavily shorted stock, and at some point investors get squeezed out of it, and we're seeing quite a bit of that action, especially with some of these stocks that we talk about every day. Why is this stock up 20, 30%? Usually there's a little bit of a short squeeze.
Yeah, I don't think we have the data handy on Celsius, but I would bet that there's
It's certainly
a decent
moving like one,
amount.
like
Well,
one of
at
those
least
amounts
more recently.
on a given day.
We'll see. We'll get some more numbers. Thanks a lot, Josh. Oh, wait, do we have to do that? Or do we just do that with Jared? I don't know. Stick around. Much more Asking for a Trend still to come. Defense Secretary Pete Hegseth has reportedly ordered senior leaders at the Pentagon and throughout the U.S. military to begin cutting 8% from the defense budget in each of the next 5 years. Now, this is according to reporting from the Washington Post that cited a memo in which Hegseth ordered the proposed cuts to be drawn up by February 24th. This has sent ripple effects to some defense names such as Palantir, which we saw fall 10% during the regular session after this report from the Post crossed. It's unclear if any of the proposed cuts would even affect spending from companies on companies like Palantir. We'll be watching that and the other defense names, however. Well, as we are talking about these cuts that are spreading throughout government, even affecting potentially the Pentagon to plan for budget cuts. Again, that's according to the Washington Post. For more, we're going to bring in Patrick Murphy, former congressman and host of Yahoo Finance's Warrior Money podcast. Patrick, good to see you. A lot of rapidly moving developments coming out of Washington, but I did want to get your take on this report that the defense secretary is asking for proposed cuts to be drawn up by the 24th, very short window of time for these proposed cuts. And I guess as someone who has been in government and has been in the military, what is the sort of, how much bloat is there at a place like the Pentagon? Is there in the Defense Department? We see other agencies being eliminated in some cases entirely. How do you think this should be approached for defense?
Yeah, Joe, well, thanks for having me on. I mean, first, the two biggest federal agencies in the federal government are the Department of Defense and the VA. And in the Department of Defense, we're talking about 8% cuts of the $850 billion a year DoD budget. We're talking about at least a 10. Like it's crazy, but it's like almost, unfortunately, like almost $100 billion, right? It's a lot of money. And it's year after year over the next 5 years. So we have a lot of threats out there that are trying to do our families harm. I mean, we still have folks that are trying to harm Americans. We see terrorist attack all over the world. We see what's going on in the Middle East. We see the aggression with China, who's being more and more aggressive by the day. So we have to be really smart about this. I get it. I'm a fiscal conservative. We got to make sure that we're spending taxpayer dollars wisely. But this was a shock to the system. And also, when you go to the services and say, hey, I want you to plan for an 8% cut every year for the next 5 years. Whew,
yeah,
that's big time.
It's tough. I mean, and we just also heard the Veterans Affairs Administration was going to be laying off 1,000 people. I mean, you talk to a lot of former service members, a lot of current service members, people who are, for your podcast. How are people, are people who are veterans, for example, are they worried right now?
They are, Julie. I mean, we our show airs on Fridays. We just had Bob Parsons, who's a Marine Vietnam veteran who started 3 companies, including GoDaddy. He's one of the Forbes most 400 wealthy Americans. There's a lot of my brother and sister veterans that are saying, hey, we just got done the longest wars in American history in Iraq and Afghanistan, over 20 years. The two signature injuries are PTSD and TBI, post-traumatic stress disorder and traumatic brain injury. We lost, Joy, over 150,000 veterans to suicide the last 20 years since 9/11. We got to do a better job of making sure we're taking care of our brothers and sister veterans. Listen, they're civic assets. They're doing great things, but there's too many that are falling through the cracks. There are too many who are dying by suicide. So I have some real problems, when we're letting go probationary folks that just joined the VA. A lot of them are veterans. Over 30% of them are veterans that are trying to do what they can to stop our brothers and sisters from taking their own life.
Patrick, thank you very much for your perspective on this. Obviously, something close to your heart, so appreciate it.
Yeah, God bless you. Thanks, Joy.
Thanks. Be sure to scan the QR code below. You can check out Patrick every Friday at 12:30 p.m. Eastern on the Yahoo Finance podcast, Warrior Money. In this past episode, Patrick and his co-host Dan Kuhn sat down with Parlay Finance CEO Alex McLeod and COO Jay Long to discuss how they are revolutionizing small business lending through innovative AI and real-time data.
Joe served in the military. My background was in helping refugees, and together a couple years ago with the Afghanistan evacuation, a lot of folks came from Afghanistan, were evacuated to the US, and a whole community in the veteran community stood up to help them. as part of those people who stood up, the PenFed Foundation helped bring across a group of incredible women, the Afghan female tactical platoon leaders, and helped them integrate into the US, think about their next jobs, their next steps, and a large number of them wanted to start their own businesses. And so the foundation asked us if we could help, and we sat down and we helped these women. And by doing this work, we realized how hard it is for them to get access to capital. You come to the US, you don't have a background or a credit score even, and suddenly you're trying to apply for a loan. As a new business owner, it is so difficult. And so we said, we cannot let this stand. We need to make it easier for small businesses. We need to help them. And that's how we ended up founding Parlay. And we now partner with credit unions and banks across the country to do that and help more small businesses.
For our chart of the day, we're looking at how reliant the market is on big tech. Yahoo Finance's Shauna Smith joins us now with a closer look. Less reliant than it was, I guess, maybe?
I was going to say, it's semi-reliant, it's less reliant, and that's the point I'm trying to make here, at least just in terms of as we compare it to last year and how reliant the market was on those handful of companies, specifically the Mag 7. So here's the top contributors to the S&P since the start of the year. And as you can see, yes, Meta and NVIDIA very much in the leadership position there. Meta contributing or accounting for 13% of the S&P's gains since the start of the year. NVIDIA in second place there at 5.7%. But then looking beyond that, some of the other top contributors that we have seen since the start of the year, and that is what I really want to zero in on. When you take a look at JP Morgan, Visa, Eli Lilly, Costco, even Walmart amongst the top contributors here to the S&P since the start of the year. And the reason why this matters is because many investors that we have had on here on Yahoo Finance strategists talking about the fact that this is a bullish sign here for the company. John Solfas over at Oppenheimer in a recent note just noting the fact that he thinks it's enough here for the current bull market that likely has legs strong enough to climb the proverbial wall of worry through 2025 as we continue to see a broadening of the rally. And this is something that many strategists have been calling for as we started 2025, and we're starting to see that, at least I guess, signs of it come to fruition here earlier on. I also want to point to the fact the performance that we've seen of the S&P 500 and compare that to the equal weight for the S&P here since the start of the year. Very much you're seeing those returns in line with each other, which just speaks to the fact that we're seeing more broader participation beyond big tech. So what does this mean on a global scale, just in terms of those investment opportunities? We put that question to Dave Mazza of Roundhill Investments. He's the CEO there earlier on today in the show. And here's what he had to say about that.
Just do a decomposition of the European market to the US equity market. The sectors are vastly different, much more cyclical, not as much of this excitement from tech. And I still think the idea of U.S. exceptionalism still has some legs, and probably will, after we sort of get through this uncertainty, especially on the trade side and tariff side, could continue to be supportive for markets. But investors are rightfully looking for other opportunities.
All right, well, certainly we are seeing investors and more strategists know some of the opportunities that this points to overseas. So yes, big tech still has played a crucial role and critical role in the performance of the S&P since the start of the year. But when you compare it to last year, the Mag 7 actually accounted for more than 50% of the S&P 500's return in 2024. So when you compare the performance here so far of Amazon, Nvidia, and Meta, the top three contributors of the Mag 7 to the S&P 500, the fact that it only counts for 22%, that, of course, then points to some of that broadening that we've been talking about, Julie.
Yes, it does. Shauna, thank you.
Thank you.
That's a wrap on today's Asking for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet. Have a great night.